In this video, I want to show you how to use moving averages effectively. Now, some people out there use them the correct way. The majority of the people out there actually don't use them the right way at all. What I typically see people doing with moving averages is that they use some sort of a moving average crossover system, and they don't really pay attention to the fact that moving averages, like other technical indicators, are lagging in nature. So as I've said in previous videos, with technical indicators, you can use them to help you build context around the chart that you're trading. But in terms of using it for an actual entry technique without using price action in conjunction with it, it's really going to force you to come unstuck and you're going to end up losing money as a result. So in this video right here, we're going to look into the right way to use moving averages. Now, typically the way that I do it is I will either use one or a combination of moving averages to let me know, which direction is the market generally trending in. So let's start off by looking at the way that one moving average can help you. And then we'll add one or two more just to help you build up that context around the market. And then of course you can choose for yourself which one works best for you, because remember, as with all other technical indicators and trading indicators, what you're trying to do is you're trying to give yourself confidence in the trades that you're taking. You're trying to make your trading process objective so that you less and less your emotions are getting involved in your trades, and hence you aren't self-sabotaging yourself. So let's jump over to the charts here. And what we've got is we've got a dollar-yen chart on the 6-hour chart. Now this actually works on any time frame. So please don't worry if you day trade the markets, or if you're even longer term than this, that's absolutely fine. The principles I'm about to show you now work on absolutely any time frame. So the first thing we'll do is we will throw on a moving average. So going to the indicators here, moving average. You can see that there's different types of moving averages that you can add here, but generally speaking, I will use an exponential moving average. You could use a simple, you could use some of the other new weird and wonderful ones out there, but a simple or an exponential one is one that I've used for literally the past 2 decades, and it's worked for me, so there's no reason to change that. So what I will do is I'm going to go in here and I'm going to change some of these settings. The first thing I'll do is I'll change the color, I'll make it a little bit thicker, and then crucially, I'm going to change the input. Now, one of the sort of like the well-regarded moving averages is the 100. You'll find that in the stock markets and the commodity markets, I'll use the 100. Sometimes I'll use the 200 as well. But the 100 seems to be the universal moving average that a lot of professional traders use. And if they're using it, then it's something that you should look into using as well, because essentially you want to get the same view as the professionals do on the markets, because that will help you make better trading decisions. So what we do when we have one moving average on the chart is essentially we look for price to be trading above or below it, and it will generally give us a bullish or a bearish sentiment on the market. If price is trading above the market, so above the moving average, and remember, moving averages, so I've got the 100 period moving average here, and what it's telling me is it's giving me the average price, or thereabouts, over the last 100 bars. I'm on a 6-hour chart here, so it's giving me the average price over the last 100 6-hour bars. So if price is above that moving average, it tells us that price is bullish. And the sentiment towards this particular currency pair is bullish for this particular period in time. Okay, and whilst it's bullish, what we want to be doing as traders is we want to be looking to buy the market. And as you can see here, as the market kind of trades above, and it gives breakouts to the upside, those breakouts obviously go on to pay you. They give you profits. Not in every situation, but for the most part, when you look at breakouts here, if the price is above the moving average, we're looking for breakouts to the upside, and typically these breakouts to the upside end up taking us into some sort of portion of profit. It obviously depends on what your strategy is in terms of taking profit, stop losses, etc., as to how profitable you will be. But just the general principle here for you to build into your trading approach is to say that whilst price is above the moving average, then you want to be buying. And whilst the market is below the moving average, as you can see here, it breaks down, then you want to be selling. Now, crucially, we're not just selling because the price is above or below. We would be selling once price is below the moving average. Then once we get a price action set up, we would be buying when the market is above the moving average for after a price action setup. So if we take a look, for example, at this opportunity over here, okay, so we've got that opportunity there. Let's get rid of that for a second. The market has traded up, which is great. It's given us a period of consolidation. We then have a resistance level there. And what you would do is you'd say, price is above the moving average, which is fantastic. I've got a price action set up over here. I'm now going to buy through those highs. Okay, and as you can see, this kind of plays out all over the charts again and again and again down here. Eventually, it then does go on to stop you out had you had your stop below the lows like that there. But then you get another opportunity over here as the market breaks through the highs, and it plays its way all the way through to the top. So you've got, in that situation there, a bunch of trades which would have made you money, one or two which would have lost you money, but overall you would have been net profitable simply by using one moving average. Now, the other approach that you can go with is you can say, well, I'm not going to use just one moving average, I'm going to use two. Okay, so you go into here, indicators again, I go to moving averages, as we can see, or average, like that. Exponential again, same thing as before. I will go in here, I'll change some of the settings, and one of the moving averages I like to use as a shorter term one is a 20 period moving average. So let's take that down to 20 over there. I will again change the style a little bit so that it's visible on my charts. Now I will wait for the shorter term moving average, so the 20 period moving average, to be above the longer term moving average to really give me a bullish bias on the market. And I'll wait for it to be below the longer term moving average, so the 20 to be below the 100 to give me a bearish bias. And then again, I would do the same thing. I would trade according to the price action. The only difference is here is that I would then also use the 20 period moving average as a little bit of a sort of like a filter to not get into the market. So let's say, for example, the market like it is over here. Okay, so let's look at, let me highlight this situation over here. If we had just been trading the 100 period moving average in this area over here, and we wanted to go short, we might have taken a short below this congestion area over here, okay? However, the market, as you can see, is above the 20 period moving average. So from that perspective, I wouldn't take that opportunity. And sure enough, what happens? The market then turns around and starts moving on its merry way to the upside. So that would have stopped you out. But by using the 20 period moving average as an additional filter, so not only are we saying the 20 needs to be below the 100 for a shorting opportunity, or it needs to be above the 100 for a buying opportunity, we're also saying that price has to be above or below, so above for a buying opportunity or below for a selling opportunity. And that will translate into a little bit more of a filter. So you will get fewer opportunities there, but you will find that your win rate does go up. Okay, so that is obviously a balancing act. You have to find the right amount of trades combined with the necessary win rate to bring you out ahead of the game, and also something that fits your personality. There's no point in filtering everything out to a point where you have one trade a week or one trade a month if you know that from a personality perspective, you're going to go in there and try and invent trades that don't exist. It's much better taking a strategy with a lower win rate, for example, but still profitable, but gets you into more trades if it means that you don't go on and self-sabotage yourself. Okay? So to summarize, moving averages are fantastic tools to help you build up context and help you understand what the sentiment of the market generally is. You don't trade them as a crossover system. So sometimes people will say, well, I'm going to trade a moving average crossover. So they would just literally get into the market as a moving average crosses. And then as it crosses back again, they will just stop and reverse their position. It's possible to do that. You will be profitable when the market condition is right. When you're in a choppy market, you'll just end up losing a lot of money. But probably more importantly, you've missed out on so many opportunities. So with this chart here, had I just got in on the crossover, so this crossover here and that cross there, that would have been one opportunity. But actually looking at this chart, trading the way that I've just described to you, I could get in over here. That would be an opportunity. So 1, 2, 3, 4, that would have stopped me out down here, but that's not a problem. Then we got another opportunity over here, 5, 6. So we would have had 6 opportunities there. One would have taken me out of the market, but I still would have been net profitable, and I would have been significantly more profitable had I just gone with the crossover based system. Okay, so I hope that makes sense to you. If you've got any questions about how to use moving averages to help you increase your win rate in your trading, please feel free to post it beneath the video here. Remember, all trading indicators are lagging, so we use them for context. We don't use them for entry. You still have to have an understanding on price action for entry, but all in all, they are a great tool to have in a trader's arsenal. Now, if you like this video, Please make sure you click the thumbs up, you hit the subscribe button, and you also hit the bell so that you get a notification as and when I release a new video. If you don't already have a strategy, if you're not already consistently profitable, then please pop along to my website. Link will be beneath the video here, and you have an opportunity there to sign up for one of my masterclasses where I will walk you through my trading framework and teach you what I'm doing right now to trade the markets, which is the same thing that all of my private trading clients are doing as well. Okay, so hurry along and do that. As I said, any questions, post it beneath the video. Otherwise, thank you so much for watching, and I'll look forward to speaking to you very, very soon. Take care now.